All right, thanks, Paul.
Okay.
Have a great morning and a great weekend. If I don't talk to you, but jump in the chat room. I'm sure people would love to see you.
Okay, see you then, bud.
All right, bye bye. All right, traders. This is Blake Morrow. You are listening to the Morning Edge webinar. I hear what Paul's saying, but I just wanted to reiterate here. This, in my opinion, this is a great example. What you see here on my screen of the blue line's the S&P. Okay, so the S&P is back at its highs. We're right at that 618, and you guys should know that. So I don't. Here, let me just show you what the S&P looks like. So here is the S&P. Okay, so we're back at the dreaded 618 retracement. Right here, okay, from all-time highs to lows, we're at the 618. So we're back here probing up against those highs again. It's like, okay, here we are again. All right, so pushing up against those highs. Great, we know where we're at. But if you look at how the DAX is responding versus the S&P, notice the DAX is not back at highs. I mean, we've rallied back overnight, but the S&P hit new highs, DAX not so much. This, again, the point I'm trying to make here is that the lack of response to central bank activity has to be alarming. Now, how many of you guys were not, and I'm going to ask you, were not on the Lunch Money webinar yesterday? Okay, they're not. You were not on the Lunch Money webinar yesterday. You were not. James says so. Okay, so there was a few. There's actually a lot of you guys that weren't, and I know that's the case because many of you live in Europe. Some of you are in Asia, in Australia. So you can't. I know it gets late. And you can't listen into the Lunch Money webinar, which is 5 hours from now. But on the Lunch Money webinar, I talked about, and just so you know, I made really good money yesterday. Matter of fact, yesterday was one of my better days of this year, and I've had some pretty good days this year. This has been a really good year of trading because the volatility has been so great. So I went on a really big rant, not because I was upset because I lost money. I did really well yesterday. We bought the euro, making a 90 pip gain in the euro dollar within a couple of minutes and then watching it go another 300 pips. I guess that was a little frustrating. But the Canadian came roaring back. The yen pairs fell. It was all good. I can't complain about yesterday, about what I made yesterday in the market money wise. But the rant that I went on yesterday was, oh my God, look at the reaction of the markets to what the ECB did. And I said, man, the ECB, just like the BOJ, has got to be really, really worried that they're getting the opposite response of what they expect. Okay, if you're the ECB and you launch a bazooka, you throw a shell out there and you shoot it at the market, and the market gives you the opposite response of what you were expecting. I am expecting to weaken my currency, strengthen asset prices, and in turn, the DAX drops several percent. European markets drop several percent. And I don't know what the exact percentages are right off the top of my head. The euro rallies several hundred pips. You've got to go, oh my God, how are we getting this negative policy response? So that's when, if you read this article here, let me pull it up for you guys, and I sent it out to the Wise Trade customers, but I'll give it to you guys. I'll put it in the chat box too. This is the ECB website. This is this morning, just a bit ago. Opinion piece by Vider Constant, I can't even pronounce his name. He's the vice president of the ECB. Mario Draghi's right-hand man, who's always sitting next to him. This week, the ECB adopted new measures to reinforce its monetary policy in the face of recent headwinds. That decision was taken against a backdrop of vocal skepticism in the media and the markets. The skeptics' reasoning is two-pronged. First, that the monetary policy is not sufficient to address the present low-growth trend, and second, that monetary policy is increasingly ineffective in any case. The notion that monetary policy alone cannot raise trend growth is mostly true, but trivial, especially if the challenges of secular stagnation highlighted by Robert Gordon in his brilliant new book are considered. The The G20 has appealed for use of other policies, notably fiscal and structural reforms. While other policies would certainly be welcome, one can have justified doubts about the implementation. Of course, you got different governments trying to implement crap that, trying to get this passed, and the right fiscal and structural reforms getting done is, that you will have doubts about its implementation because you're dealing with governments, all right? For a start, active stabilizing fiscal policy is restricted by law in the EU and any politics in the US. More generally, countries that can use fiscal space won't, and many that would use it shouldn't. That leaves us with structural reforms, some like upgrading education and judicial efficiency are important, but take a long time to implement and produce results. The structural reforms economists have in mind, liberalization and deregulation of markets lead to lower wages and prices in the short term, which does not help inflation normalization. And concerning unemployment, high productivity often initially implies labor saving. This goes on to say, you can read through it. To normalize inflation in the euro area, we urgently need higher growth that can reduce negative output and unemployment gaps, using all really available policies. If not monetary policy, then what? And see, this is the question right here. This right here is exactly the problem. If not monetary policy, then what? Okay. That is really what everybody's asking, and that's why you're having this lack of response to monetary policy. Here, I'm going to put this in the chat box so you guys can read it. It's an important piece. So it's in the chat box now. There you go. So you guys can read it at your leisure. But it's really an important piece that really shows that the market, that even ECB, like the ECB is going, okay, well, we're doing what we can. We're a little skeptical that fiscal and structural reforms are going to be able to do anything, but then what's the answer? What's the solution? And that's again, this is where the market is, you're seeing that negative response in the markets, where the markets are becoming immune or numb to central bank activity, which then poses the question, if that ain't going to help, what the hell is? And if we can't figure it out, what happens from here? Because, again, this is the conversation that we had yesterday, and I got to put you on break here in a second. But look, you guys, many of you, and I say many of you because, you're in the markets right now because you have some money, because you're trading the markets. Hopefully you're not trading with money you can afford to lose, but you're trading with, you're trading with money that you have set aside to, make an additional income. But most of you probably, like me, have money set aside and you have it in capital markets. Okay, so whether you're looking at European markets or U.S. markets or Asian markets or wherever you're looking across the globe, what you'll notice is since the financial crisis, we've seen a massive increase in your asset value. So what let's say you have a retirement account and you had $1 million in your retirement account, you might have seen it go from $1 million to $500,000 to 1.5 million. Okay, I'm just using this is a very crappy example, but just kind of giving you an overview, an example, if not a good example, just an example. Okay, you had $1 million, turned into $500,000, now it's up to 1.5 million. Great. What I would hate to see happen to you is that we get into a situation in the global economy where the global economy cannot figure out how to stabilize prices no matter what they do. And no matter how much the central banks try to push, they are unable to keep asset prices elevated at current prices. I think that the stock market is going to correct. I do think that the S&P is going to 1,600. Okay. What I'm more concerned about, because of the recent response to central bank activity, is that the acceleration to the downside could be greater or exceed this level. And that would really pain me to see your account go from a million to a half a million to 1.5 million to 700,000. I'm just using that as a very rough example. The reason why I had this conversation yesterday with everybody on Lunch Money is simply put that I said, look, I'm not a broker. I'm not a financial advisor. I gave up my license in 1998. Okay, I gave it up. You don't need it when you trade. Okay, so I didn't, I didn't want it. I didn't like managing other people's money. It just, telling people what to buy and sell. It just wasn't my cup of tea. I only did it for like a year. Uh, it, it, if if you feel, or we feel, that the markets are becoming unresponsive to central bank policies, and we don't know what the solution is, and if it's structural, or as the ECB vice president said, if it's structural or fiscal reforms, it's going to take a while to really work through the market. And that's granted, that's if governments really get on it right now. The risk is that the capital markets, your respective equity markets, and where you have maybe a bulk of your money, may continue to correct lower. And so if that truly is the case and you are concerned about that, which I am, I would suggest that you talk to your broker, whoever your financial advisors are, and you tell them, hey, look, I think it might be a good idea to be a little defensive right now. What are some measures I can take to protect myself? Those are conversations I can't have with you because I'm not licensed to do so. Those are conversations that I believe you should have with whoever your respective financial advisor or broker is. And think defensive, because what I'm seeing here is I'm seeing things that are very scary to me. And I don't want to scare the crap out of you, like, oh my God, the market's going to lose, 100% of its value in the next, 30 days. I don't want you to scare you like that. I think that would be unnecessary. I just think that the markets may correct a little bit more than I had previously anticipated. And if the case, I'd hope you were in some sort of defensive position to withstand some sort of pullback in these markets. Okay, so again, I hope I hope I hope you appreciate the conversation we're having right now. It was a very heated conversation yesterday on the Lunch Money webinar. It's less heated right now because I've been up since 3 o'clock this morning, and it's 5:30 in the morning here. But I hope you guys appreciate my concern, and perhaps it at least sparks some conversations with you and your financial advisor, or you and your loved one, or your partner, or to think defensive, okay? Because if you guys are out there looking at the market saying, well, I'm looking for the S&P to go to 3,000 here in the next year, I think we're gonna. I don't really think the markets are going to be doing that. I really don't, based on what we're seeing here. But maybe I'm wrong. All right, guys. So I'm going to put you on hold. I realized I talked a little bit too long, so I'm going to put you guys on hold for a little bit. I hope you guys are having a great day. Happy Friday, TGIF. I'll be back in just a few minutes. And thanks everybody for being here. All right. See you in a bit.